Well, thank you, everyone who was able to join us, and others will be joining us shortly. Welcome, welcome. Thank you for taking the time this afternoon to join us in what will prove to be a very, very important webinar. And I've got a very special guest that I'm going to introduce shortly. The topic of today's webinar is basically market outlook. We've had a tremendous last couple of years. There's a lot of moving parts. It's been stressful and exciting year, or the last couple of years, should I say? And I think it's timely to discuss what's happening in the markets, what's happening in the economy, and what to look out for in the next 12 to 18 months, both from an economy point of view and a markets point of view, and also politics.
All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Today is Wednesday, December the 3rd, and this webinar is being recorded, and we're hoping to have it sent out to everyone probably in the next week or 10 days. And it will also be posted on our website and our new YouTube channel as well. So when it comes out, please feel free to forward it to whoever you wish. I'm hoping that in 2026 to have 3 or 4 such webinars for all the clients and accountants and anybody interested in different subject matters. So I welcome any comments anyone has got for any future webinars they may want to learn about. Questions. If anybody's got any questions for myself or Patrick, please email them to me. I've already received quite a few questions that I will post to Patrick at the end. But during the presentation, if anybody's got any questions, please email them to me at karim.visram@rbc.com. And I promise to have Patrick address them at the end of the presentation. If we don't have time at the end, then I'll promise to have Patrick respond to everyone who has any questions on them. Now, the format and the agenda for this presentation is Patrick's presentation is going to be around approximately 30-35 minutes, and then we're going to leave about 10-15 minutes for Q&A. So please don't hesitate to send me any Q&A. We're gonna try and end the presentation within sort of before 3:30, so within 45 minutes to an hour maximum. Okay, so now let me take a minute or so to introduce Patrick. But before I formally read his bio and tell you all the great work Patrick has done, I've known Patrick for a very long time, and he's one of my key resources over the last 15 odd years that I've used on our portfolio advisory group. He's one of the first people I would call up if got any questions on any particular stock or anything regarding to the equity markets, whether Canadian or U.S. So I really value his knowledge and his expertise, and the fact that he's a key resource to me. So Patrick, thank you for over the last 15 odd years that you've been there for me and my team. I really appreciate it. So let me formally introduce Patrick. Patrick McAllister. He's the manager of the Equity Advisory and Portfolio Management Group. Patrick is responsible for the management of our Toronto-based Canadian and U.S. equity team. So he's got a big, heavy weight on his shoulder. Patrick joined the Portfolio Advisory Group in 2013 after completing the RBC Wealth Management Journalist Program. Prior to joining RBC Wealth Management, Patrick spent 4 years at RBC Capital Markets in the corporate finance and debt capital markets. Patrick holds a Bachelor of Commerce degree from McGill University and is a CFA charter holder like myself. Patrick is a co-chair of the Canadian Focus List Investment Committee. And in addition to that, he's also a portfolio manager of key Canadian equity portfolios. So without further ado, Patrick, take it away.
All right. Thank you very much, Karim. I'm excited that I'm going to be on YouTube. I'm going to go home and tell my wife tonight that I'm about to be an influencer. That's sure to excite her. Really
You will,
happy
Patrick,
to
you
have the
will.
opportunity to chat with you all this afternoon. The title of the presentation is, tariffs. This is the key word of 2025. As Karim alluded to in his opening remarks, it's been a very eventful year. And when it came to tariffs, we've had plenty of bark. So much bark. We're surely sick of that word. But where's the bite? We saw the bite earlier this year. It was a very tumultuous late winter, early spring. The S&P 500 suffered a 20% correction into the depths of that downturn in April. But in terms of the economic bite of tariffs, it's been much less severe than feared. In the spring, we were fearing recession was just around the corner, and yet the impact from tariffs has been less severe. We've seen the pendulum swing in favor of some de-escalation on the trade front as well. That's been hugely helpful. And the fears of recession have receded. And so that bite that we saw in the market in the spring, thankfully that has faded. And again, as Karim alluded to in his opening remarks, we're on course here for another very strong year in equity markets. We could be up mid-teens, at least on the S&P 500, knock on wood, in 2025. That's the year-to-date measure. And we're coming off of years in 2024 and 2023 of 20% plus returns. And so the market has cheered lower risk of recession. And when we look into 2026, the outlook for the economy is one of growth. Modest growth, but hopefully enough to keep this expansion enduring and enough that corporates can generate the kind of earnings that they now need to justify these higher valuations. So let me give a little bit of a run through on some of the key highlights from this afternoon's presentations. As I just mentioned, we do expect growth, economic growth for the North American economies in 2026. Tariffs are a bad news story. They have surely hurt growth, but perhaps the worst is behind us. And we do see some tailwinds for growth in 2026. We're seeing central banks on both sides of the border, Canada and the US, they're cutting rates. This should be stimulative. We've got some fiscal thrust coming from the One Big Beautiful Bill Act, as well as the Canadian budget that was announced last month. The consumer is certainly not a monolith. Parts of the consumer complex are suffering, low-income consumers in particular, but high-income consumers are doing more than their fair share to drive consumption and seem to be on still pretty good footing. And I'm hopeful if we can get some level of policy certainty, and that's a low bar. By that, I mean, let's not have the kind of policy uncertainty that we suffered in the first half of 2025. If we can understand the rules of engagement on trade in 2026, maybe that can get businesses a little bit more confident investing in things that aren't necessarily data centers. Markets have rallied appreciably this year. They're reflecting that rosier economic outlook as they should be, as that fear of recession has receded into the rearview mirror. That's the good news. When you look at your statement today from Dominion Securities, you're feeling good, hopefully, about where your portfolio has gone this year and certainly the last couple of years. That's the good news. The flip side of that coin is that valuations have expanded. Stocks are more expensive. And so now corporates need to deliver on the earnings that are expected of them moving forward. There's always risks, and we're watching a couple in the market right now. We're watching inflation, which has been persistently sticky and elevated above central bank targets in the US. We are watching the labor market. And certainly, last but not least, and this has been squarely in focus in markets over the last few weeks, we're watching the AI narrative and the AI enthusiasm that we see embedded in equity prices today. Now, if I was giving advice to anyone, if I was giving advice to my parents at this juncture, with markets having done so well, with modest growth on the horizon, but more demanding valuations, my advice would be make sure you stay on target, right? You work with a team like Karim's for a number of reasons, but one of those reasons and one of those ways that Karim's team is helping you is by setting the right target of equities and bonds within your portfolio that reflect your circumstances, your time horizon, your risk tolerance, right? And so you've set those targets with all of those dynamics in mind. And I would make sure that I'm eschewing pretty close to those long-term strategic targets. And after a few really good years in equities, making sure that that equity weighting hasn't drifted materially above my long-term equity target. And then last but not least, I do want to leave listeners today with a little bit of how we put the difficult period earlier in 2025 in context. We are going to, as equity investors, encounter more corrections in our investing lives. How do we think about those? Look, we own equities not for the next 6 to 12 months. We own equities for the long term, the next 5, 10, 20 years down the line. And so when we get in those tough moments, we encourage clients to think about the long term. And hopefully I can share a couple of exhibits that help put the long term in context that we can return to in the future. So slow growth ahead. Tariffs, as I mentioned, they're not good for economic growth. All else being equal, they're going to weigh against economic growth. But the hit to the economy has been far less severe than fear, right? And one of the biggest reasons for that is that the actual tariff rates that have been implemented are some way below the headline or theoretical tariff rates that we read about in the Financial Times, the Wall Street Journal, the Globe and Mail. And so have a look at this exhibit, right? The dark blue line, that's that headline rate. That's the rate that screams to you off a Truth Social feed, such that you're following that. More likely, you're seeing it in the Globe and Mail, you're seeing it in the Financial Times. These are the big numbers, right? When Trump says he's going to hit Canada with a blanket 30-35% tariff rate, these are the kind of headline numbers that scream at us. But now that tariffs have been in place for some time, we now can actually look at the receipts, right? Quite literally, we can look at what the U.S. government has been collecting in the form of tariff duties at the border. And what we see, and this data is reported on a lag, but what we can see is that actual tariff rate, which is the yellow line here, has been some way shy, let's call it 4-5 percentage points shy of what that headline theoretical tariff rate is. And that's a good news. And that's why the bite of tariffs has been less severe than feared. Why is that actual tariff rate below the expected tariff rate? There's a number of different reasons. The first one I always think about kind of tongue in cheek is, can you imagine a worse job earlier in 2025 than being a U.S. Customs agent and having to determine what duty rate, what tariff rate to apply to what goods from what country? I think one of the reasons that the actual tariff rate is below the expected tariff rate is just confusion. Who could have possibly sorted this out in real time as all these tariff threats were getting made and implemented? Two, and probably more of the picture here, is just resourcing, right? If there was an input, if I'm a US manufacturer and I was procuring something in China and all of a sudden China's getting hit by some egregious tariff rate, well, I'm going to look to other sources for that input. Maybe I can find that domestically. Maybe it's a little bit more expensive, but after accounting for tariffs, it's a lot better to source that domestically. Maybe I can source that elsewhere internationally, still pay a tariff, but less egregious than, say, China was as my original supply chain. And then last but not least, and certainly this runs against what the US administration would like to see, but there's some evidence to suggest that there's just been some rerouting. I'm still buying that good from China, but I'm going to backdoor that in through another location and put another country seal on it so that I can bring that in at a lower duty rate. I think all of these elements are having an impact, but the important takeaway is that the actual tariff rate is not quite as dramatic as the headline tariff rates, and that's been a good news story. And so when we look into 2026, from a North American perspective, again, growth not spectacular, 1 to 1.5% real GDP growth. And so that growth would naturally be higher in the absence of tariffs, but the worst could be over. And maybe as 2026 develops, I mentioned there's a couple tailwinds there. Central bank rate cuts should be stimulative. Fiscal thrust from the One Big Beautiful Bill, the federal budget here in Canada, that should likewise be stimulative. Can the consumer, namely the high income consumer, stay on their feet and continue to purchase and continue to spend? And last but not least, can businesses get a little bit more confident that they understand the rules of engagement and feel more confident investing in their businesses again? If that can happen, then I think there is maybe some reason for optimism that the actual growth experienced in 2026 could be a little bit ahead of this forecast. Now, The US Federal Reserve is looking at a labor market, and we'll talk about this a little bit later in the presentation. The labor market is showing signs of softening. The rate of hiring in the US has receded. It's slowed down. And so the US Central Bank has cut twice in recent months, 225 basis point rate cuts. They are expected to cut again in December because they're trying to support that slackening labor market. But what they need to remain acutely focused on is inflation. And the inflationary impact of tariffs is going to be more severe in the US because they're the ones where the consumer is going to end up paying some of that tariff rate. And in the US, we see inflation rates staying persistently high, persistently above target, I should say. Nobody's expecting the kind of inflationary shock that we saw coming out of COVID, where we saw CPI max out at 8 or 9% year over year growth. But rather it's this pernicious 3% tariff, 3% inflation rate, I should say, that is above the central bank's 2% target and continues to erode purchasing power, particularly for those lower to middle income consumers. This is something that, all else being equal, would encourage the Fed to maintain or even increase interest rates, and they need to not take their eye off the inflationary ball while they're cutting rates to support the labor market. So I would say the theme of like the first 6 slides so far has been that things have been much better than feared, and Canada is very much a case in point in that regard. It's really crazy to reflect back on the year that we've had. And before this was about China, before this trade uncertainty, this trade war was about anybody else across the globe, it was really initially in January, February, March, it was about Canada and Mexico. And I felt as a Canadian, I'm sitting there like, hey, like I thought we were neighbors. I thought we were friends. And yet we were squarely in the Trump administration's crosshairs, at least from a rhetoric perspective, early in 2025. Then we got Liberation Day, and it turned out that there's a lot more countries in the crosshairs than just Canada, Mexico, and indeed China. And there's this tremendous amount of uncertainty, this worry of recession. And the Bank of Canada, they usually put one set of forecasts out there for where they think the economy is going to go, where they think the labor market is going to go over the subsequent 12 to 18 months. But such was the level of uncertainty that the Bank of Canada did something that they don't normally do. They actually presented a range of forecasts. They had their best case scenario, their base case or maybe mid case scenario, let's call it, and then they had their low case scenario, which was indeed a forecast of recession, that if these draconian tariff levels were left in place for any period of time, Canada, as a major trading partner with the importance of that relationship with the US, we could have very easily fallen into recession. Now, fast forward 6 to 7 months since that forecast was made in May, and we can happily say that the Canadian economy has traversed a path that looks a lot like the Bank of Canada's best case scenario. So that doesn't hold for everyone, right? And I want to be very clear about that, right? Canada has traversed this best case scenario, but we have to recognize that low-income consumers that have exhausted their savings, that have seen inflation bite into their purchasing power over the last 5 years, they're not feeling that bullish about their prospects. And then you think about if you're engaged in the auto manufacturing sector, steel, aluminum, where you're facing down these sector-specific tariff rates, there is really real pain out there under the surface. And so I'm at pains to paint a picture where, in aggregate, the Canadian economy is doing much better than feared. But let's not forget that there are pockets of pain out there geographically and industry by industry and indeed by income cohort. But it's really been those sector-specific tariffs that have been impactful, because for the rest of Canadian goods, USMCA or the CUSMCA or CUSMA, whatever you want to call this trade pact, it has been largely in force. Outside of those affected sector-specific tariffs, the rest of Canadian goods, the rest of the value of Canadian goods has still been accessing the US market on a duty-free basis. And RBC estimates that roughly 90% of the value of the Canadian goods that we export into the US market are still passing that border on a duty-free basis, thanks to the USMCA. And if we look at Canada relative to a bunch of major trading partners for the US, we are at the very low end of the effective duty rates on US imports. You see Canada there. The more up-to-date number, this figure is from July. It's probably more mid-single digits, maybe let's call it 7% effective duty rate for Canadian goods entering the US market. But that puts us in a much better relative position versus a lot of other major US trading partners. And that's a really good news story to look good on that relative basis. It is still impactful because of the importance of that US trade relationship for Canada, but we're in a much better position than we otherwise could have been without the USMCA remaining mostly intact and mostly in force. And so this raises the obvious question. We've read in the press about Canadian-US trade talks. Those have been on pause in the wake of the spat over Ontario's Reagan ads. But we expect that these talks will resume sometime, maybe if not in 2025, then in early 2026. And indeed, there is a structural mechanism within the USMCA where there was already a review between the US, Mexico, and Canada to review this trade pact in the summer of 2026. So this is going to happen. Now, the question is, does the USMCA remain, does it survive in its current form? And I'm pretty bullish, pretty optimistic that it will survive in pretty close to its current form. And the major reason for that is US politics, right? In November of 2026, Americans go to the polls for the midterm elections. And I think as soon as the calendar, I mean, not even as the calendar turns to 2026, we already see it happening today in some of these special elections. The US political apparatus is squarely focused on the US midterms. We know that the Republican advantage in both branches of Congress, be it the House or the Senate, that Republican advantage is narrow, and they're going to be really focused on maintaining those advantages for the back half of the Trump presidency. And so in 2026, with the midterms being so in focus, to me, it means that trade becomes a real state level issue. And I think trade becoming a state level issue plays extremely well from a Canadian perspective, because when you look at that map on the left-hand side, you see a lot of red. Each one of those states colored in red counts Canada as its #1 export destination, its #1 export trade partner. And that stands to be the case for 2/3 of US states, right? And so as the midterms are in focus, trade becomes a state level issue. That works well for Canada. And what I hope is that it causes the US administration to be a little bit less antagonistic, a little bit more pragmatic with how it approaches Canada on the trade file. That doesn't mean that there won't be some give and take on the USMCA. Canada has already given on several fronts, right? We struck down the digital service tax. We've made concessions on the border. We've increased our defense spending. Maybe we have to do things like carve out a little bit more dairy quota, but I am positive, cautiously optimistic that the USMCA remains in place in something approximating its current state. And that's a very good news story for Canada going forward in 2026 and beyond. Now, when I talk to clients, Karim, I get a lot of opportunities to kind of travel across the country and meet with advisors and meet with their clients. And for the last several years, there's been, I think, an overriding tone of negativity towards the Canadian economy. Maybe that's starting to turn a little bit of late. I think the new Carney government has a mandate that's a little bit more pro-growth, and we'll wait to see the impact that will have again in 2026 and beyond. But there has been this overwhelming feeling of negativity around the Canadian economy, and that is very reasonable, right? Canadian economic growth has been underwhelming. Canadian economic growth adjusted for population growth, so on a per capita basis, has been negative as often as maybe it's been positive in recent years. But the point I'm at pains to make to clients who maybe extend their thinking about the Canadian economy to their Canadian equity portfolios is that the Canadian equity market is not a mirror image of the Canadian economy. The composition of sectors is very different, and the geographic diversification of the revenue generated by all the publicly listed companies in Canada is probably a lot more diversified than we would naturally give it credit for, right? If you look at that pie chart on the left-hand side, less than 50 cents on every dollar in revenue generated by the Canadian publicly listed companies is coming from Canada, 46 cents on the dollar to be exact. Another 32 cents is coming from the US and another 20 cents is coming from abroad. And so different sectoral composition, diverse revenue base. The Canadian stock market is surely not a reflection or a direct reflection of only the Canadian economy. And indeed, there's a number of sectors in which we can identify kind of global leaders, companies that we think can compound their earnings sustainably for many years into the future. Companies in industries or sectors such as technology and industrials that actually generate the preponderance of their revenue from non-domestic sources, from sources outside of Canada's borders. I'll go back to what I alluded to earlier. We as Canadians were kind of at pains to understand why we were so firmly in the US administration's crosshairs earlier this year. Again, January, February, March, before this was about other countries, this was about Canada and Mexico. And who at that point would have thought that we'd see the great year that we've seen from the TSX composite in 2025? The TSX is up roughly 30% year to date, which is incredible and outpacing many other developed markets the world over. The TSX is one of the top performing equity markets in 2025. And I don't think many of us would have envisioned that, again, going back in January, February, and March. Gold has been a big part of that story. Gold has had a tremendous rally over the past couple of years here. That has led the materials sector higher. In fact, if you actually stripped the gold sector out of the TSX performance in 2025, the TSX would be up, air quotes, only 22%. But it gives you an order of magnitude there of just how big that gold contribution has been. Financials have performed extremely well. That's been led higher by the banks, which have been very strong in the second half of 2025. I'll talk about them in a few moments. And energy as well has performed reasonably well, despite expectations in the oil market of an excess supply market in 2026. So let me talk about gold. You know, Karim, you and I were chatting earlier this week, and you promised me this was going to be one of the areas where we got some questions. So I'll be quick on gold here. When we think about managing money, and Karim, you mentioned the Canadian Focus List, of which I'm co-chair and sit on that committee with a number of my colleagues. When we think about managing that portfolio, we think about long-term owning a concentrated number of businesses. We don't think about owning stocks. We think about owning shares in the underlying businesses. And we're looking for those high quality businesses that we think have a competitive moat, some kind of pricing power, visibility, good management teams that have the conditions in place to visibly compound earnings for many years into the future. And unfortunately, under that kind of philosophy, gold producers haven't necessarily met many of those quality hallmarks. Traditionally, what we've seen historically, what we have seen from the gold producers has been we get into a positive cycle for the underlying commodity, gold prices appreciate, and gold producers at times get in their own way. They engage in acquisitions that only make sense at really high gold prices. They sanction new projects that only make sense at really high gold prices, so that if and when gold prices recede from those high levels, all of a sudden, those bets look misplaced. And that's what I'm showing on the left-hand side here. It's just the track record of gold equities with respect to returns on the equity that we've invested in them. They've been historically very mixed and often negative. Now, the key question always in investing is less what's going on in the rearview mirror, but what's in front of us, right? Well, the here and now is that gold prices, I believe this morning, were at 4,200-ish per ounce. And at that level, gold producers are generating the biggest margins that we've seen in years, maybe that we've ever seen. And so I think the key for gold prices, especially if they want to be considered in that high quality business bucket in which we've traditionally fished in our portfolios, is they've got to take those cash flows and be good stewards of that cash flow and really pay heed to paying down debt And I have to give them credit. They've done this. They delevered and paid down debt. And what I'd really love to see from them is increasing the cash returns to shareholders. That means paying out dividends and increasing dividends. And that means buying back shares opportunistically. And this is a playbook that we've seen from the oil and gas sector coming out of COVID. So let's say the last 3 or 4 years, and they've executed it to great effect. Delever and start returning more and more cash to shareholders. I think if we saw that from the gold sector, that would really stand them in good stead. And then, of course, we need to see gold prices be sustained at these high levels to make this all work. It's in that area that I have maybe a little bit more questions. Maybe we'll return to that, Karim, in Q&A.
Yeah, we've got some questions on that, definitely.
Perfect. So another area of the Canadian market that's worked great, particularly in the back half of this year, has been the banks, right? And I think that banks, I'll go back to my earlier comments. The Canadian equity market is not a reflection of the Canadian economy. Less true for the Canadian banks. Many of the Canadian banks have businesses outside of Canada's borders, but to a large extent, the crown jewels here are really the Canadian domestic banking franchises. And those banking franchises are very much a reflection of the Canadian economy. And I think once we got past the uncertainty, once we saw that the USMCA for the most part was being respected, all of a sudden things for Canada started to look a lot better than we feared earlier in the year. And I think that was directly reflected in how banks performed in the second half, where we saw the earnings multiple on banks. So the price to earnings multiple being the price for each dollar of earnings that investors are willing to pay to purchase bank stocks. That's what you see in the dark black line on this chart. And you can see it kind of go up and to the right. We saw expansion in that multiple. We saw expansion in what investors were willing to pay for Canadian bank stocks. And so that's really done a great job in powering returns. I think moving forward into 2026, I don't expect that we're going to see as much by way of PE multiple or price to earnings multiple expansion. I think for the banks to continue to work, you need to see earnings revisions continue to move to the upside. And indeed, we've seen some of that, but that's going to have to continue into 2026. So that means USMCA stays in force. That means that the outlook for credit is relatively benign and better than expected. And maybe if we get a little bit more growth, maybe loan growth kind of picks up a little bit as well, and bank earnings can continue to propel bank shares. But I'm not holding my breath for continued multiple expansion. And then last but not least, oil producers. This was a great trade coming out of COVID. And we did really well in our portfolios, in our oil producers from kind of 2021 onwards. I mentioned the playbook. They started redirecting free cash flow, first to pay down debt, and then increasingly, as they were meeting debt threshold targets, increasingly directing more and more cash flow to dividend increases and buybacks. That's worked great for the Canadian producers. We were able to kind of ride two tailwinds along the way there. We had commodity prices that were improving coming out of the COVID era lows. And then we also had valuations for Canadian oil producers that were extremely discounted. I think at this point, the oil market environment in 2026 doesn't look overly exciting. It does look like an excess supplied market. Maybe that gets better and tighter in 2027. Valuations for the Canadian energy producers don't look tremendously exciting here. And yet, despite oil prices being kind of wobbly yet, the oil producer share prices have more or less performed reasonably well against that backdrop. And I think part of that, is down to the change in tone in Ottawa that I alluded to earlier, much more of a pro-growth mentality. Let's make it clear, there are a lot of hurdles to clear before we see new pipelines get built, a lot of consultations that need to be made with First Nations, with affected provinces. So yes, we've got this memorandum of understanding between Ottawa and Alberta. I think maybe that's a great first step from an energy perspective, but there's a lot of hurdles that need to be cleared. But it certainly feels like the tone in Ottawa is much more supportive of that sector than maybe it's been in prior years. So Canadian equities have performed well. We're going to talk about the US more in a moment. They've performed well as well in 2025. That's the good news when we look at our DS statement. The flip side of the coin, as I alluded to earlier, is that stocks are a little bit more expensive. They're more expensive than they were at the beginning of the year. They're certainly more expensive than they were in the April lows in the wake of Liberation Day. So Canadian equities today, that price to earnings ratio is 17 times. That's in excess of the long-term average. The US equity market trading at close to 23 times, likewise in excess of the long-term average. US market continues to trade at a handsome premium relative to the Canadian equity market. And I think that makes sense, right? When we think about some of these heavyweight technology businesses with incredible competitive moats and incredible growth algorithms and growth prospects, these should trade at a premium to Canadian equities. And yet, when we look into 2026, in terms of the earnings expectations for the TSX and the S&P 500, they're roughly similar. Call it 15% on both benchmarks. And so the Canadian equity market trading a little bit cheaper, premium to the long-term average, but not as stretched perhaps as the US market, certainly not as exposed to AI enthusiasm as we'll discuss in a moment. And we have to take this TSX earnings forecast with a grain of salt because it's always going to be commodity price dependent because we do have such a large part of our market that's tied to resources. But I do think that this setup augurs fairly well for the TSX to continue hopefully some positive relative performance into 2026. So the US, and there's the word bubble, right? This word bubble has been screaming at us from the financial press for, I feel like really for the last maybe 3 or 4 weeks. And the first thing I want to say about US equities and is this a bubble is, what's your interpretation of bubble? Because I'm not sure that there's a textbook definition on what meets a bubble. Is there a lot of AI enthusiasm embedded in valuations, particularly of certain sectors and certain stocks in the US equity market that could be at risk if that AI enthusiasm narrative meets some kind of DeepSeek moment? Absolutely. Are we facing the kind of bubbly conditions, and this is more my definition of what a bubble is, are we facing the same kind of frothy conditions that we saw in March of 2000 at the height of the market before the tech wreck? I would say that we're not. And so I'll unpack that a little bit more in the next few slides. So first, a quick comment on performance of the S&P 500 in 2025. Again, another good year. As at Friday, the market was up 18%. And that's coming on the heels of 25% total return in 2024 and 26% in 2023. So we've been on a good run here. That in and of itself doesn't mean that needs to end anytime soon. It does mean that maybe we want to adjust, make sure that we're on target with our long-term equity allocation and maybe adjust our expectations. I'm not sure that I would bet on 20% again in 2026, but it has been a good run. Mag 7, that magnificent 7 group of large cap US tech stocks, that performance is getting really bifurcated. Like we've had big winners in the form of Google and Nvidia, but we've had some losers and laggards on the other side. So the Mag 7 is still propelling performance. If you strip the Mag 7 out of the S&P 500, the S&P 490 or 493, as we like to call it, would be up 15% versus the benchmark at 18%. But it's really the Googles and Nvidia of the world that are doing the bulk of that heavy lifting. And then the last point I want to make here is that the AI exposure and that AI enthusiasm, it extends well beyond just tech and telecom, right? So if you look at the right-hand side and you see year-to-date performance by sector, nobody's going to be surprised that telecom is at the top of that list, right? We've got, I believe, Google falls under telecom, Meta falls under telecom as well. Technology, okay, yeah, that's up 24%. Look at the third item on that list, utilities. Utilities are usually, those are supposed to be your boring, defensive dividend payers. But in 2025, with the AI narrative, with the assumption that we're going to need massive increases in power to power all these data centers in the years to come, utilities have taken on a little bit of a growth connotation, a little bit of a growth multiple, growth outlook in 2025. And that's just interesting to me. And again, I just make that point that AI exposure, it's not just tech and telecom. You see AI related enthusiasm embedded in the forecast and outlook for utilities and a number of companies in the industrial sector as well. So let me talk about, before returning to the AI narrative, let me talk a little bit about a couple of the other cautionary indicators that we're watching. I'll talk about labor and I'll talk about inflation. So the labor market, I think this is a great kind of turn of phrase. It's been an interesting labor market here for quite some time now, and it's been termed the no hire, no fire labor market. And what we're seeing from corporations broadly is very low layoffs. Corporations have been loath to send people home and to cut jobs. And I think part of that comes from the COVID experience, right? Where there's a lot of layoffs earlier in COVID, right? It looked like the world was going to end, or it felt that way. And there was a lot of layoffs. But then when the economy came back into gear and corporations tried to get that labor back onto their ship, it proved incredibly hard to do so. And it was very much a seller's market in terms of labor. And so I think with that lesson so close in the rear view, corporations have been reticent to let go of talent, right? And so that accounts for the low amount of layoffs that we've seen. But at the same time, they haven't been hiring a lot either. It's been a very low hiring market as well. And I think there's enough, and whether this is narrative or whether this is truth, I think we'll see how this plays out. But I think more companies are feeling confident that they'll be able to do more and grow with less or the same headcount as they start to hopefully see some AI efficiencies in their business. And there's a number of studies out there. Some say that AI is already, creating ROI in businesses. Some say that it's not. Somewhere in between probably lies the truth. I think it will add a lot of productivity to businesses moving forward. And will that allow businesses to do more with the same headcount or do more with less? That is something that we'll be watching. And if they're doing more with less, then we'll have to keep an eye on that labor market as a cautionary indicator for the economy and by extension for markets. So the Fed, as I mentioned earlier, they're trying to support the labor market because hiring has continued to slow. So they're cutting rates to support the labor market, but they can't take their eye off of inflation because I think the number is 25% CPI cumulatively over the last 5 years. That is impacting households. They're not feeling great about their prospects. You're seeing this reflected in popularity surveys of the U.S. administration right now. This continues to be a consistent issue. And again, we're not expecting a spike in inflation again, like we saw with the economy coming back online and the supply chain snarls that we saw in the wake of COVID. But that 3% sticky inflation is problematic. And central banks really need to keep an eye that 3% doesn't become 3.5% or become 4%, right? And if you look at the chart on the right-hand side there, that steely gray line, that's U.S. services inflation, and it's been sticky at 4% and kind of stuck there, right? And then if you look at that dashed line, that's goods inflation, and it's moving in the wrong direction, right? And part of that, I would think, is the impact of tariffs. And so we've got persistently sticky services inflation, which I think is about 65% of the inflationary consumer basket there. And then we've got goods moving in the wrong direction. So central banks keeping a lid on inflation, that's going to be the needle that they try to thread between the labor market and inflation. So we're watching that dynamic. And then last but not least, right, cautionary indicator number 3, can the AI enthusiasm be maintained? We had an incredible moment back in January of this year. I think it was a Monday after the weekend that the DeepSeek model kind of hit the market. And all of a sudden, I think NVIDIA was down that day, mid-teens percentage points, as everyone was kind of taking a step back and assessing, whoa, what does this cheaper model trained on older chips, with less computing power, what does this mean for our outlook for AI and our need for just boundless demand for AI data centers, right? Nobody saw that coming. Even more recently, we've seen Google maybe take some steps forward with Gemini, take some steps forward perhaps with potential commitments to sell some of their chips, I should say. And you've started to see some question marks getting asked about some of the big publicly traded companies that have close partnerships with OpenAI. And so you're starting to see a little bit of a bifurcation in the AI enthusiasm narrative. So it's hugely important to markets. It's hugely important to the growth outlook. The numbers you have in front of you are the CapEx intentions amongst the Mag 7. And the numbers are huge, right? Over $350 billion US dollars in 2025, almost $450 billion expected in 2026. And these companies are good for those checks. They are becoming more capitally intensive businesses in the process, but these are hugely free cash flow generative businesses. And so, we don't worry about the credit quality of these businesses or their ability to finance this kind of spending. Maybe Tesla is a bit of an exception, but certainly, Microsoft, Meta, Alphabet, Amazon, Apple, these are some of the most cash flow generative best businesses that capitalism has ever devised. And, they are certainly good for the cash flow set against this investment. But we are seeing concentration amongst those big companies, right? The top 10 stocks as a percentage of the overall S&P 500 index is getting increasingly concentrated, more concentrated than it was at the height of the dot-com boom in March of 2000, right? And that top 10 stocks of the S&P 500, as you look at the right-hand side there, it's populated by the large tech companies, right? NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, Broadcom, Tesla, all of the top 8 there. Now, the other thing that you can say is that, yes, the index is getting more concentrated in terms of the percentage of overall market cap coming from those top 10 stocks. But the other thing to note is that more of the earnings generated by the S&P 500 is also coming from these companies. So it's not a wholly unhealthy kind of situation here. Where we do see dynamics that look a little bit frothy is maybe in the private markets, right? Maybe less so in the public markets, but certainly in the private markets, you probably have to squint to see this. But this is funding valuations in private artificial intelligence funding rounds, right? And so this is EV to revenue. So this is what investors are paying to invest in each dollar of revenue generated by a number of AI companies, right? And I really should look this up because I kind of laugh at it because it sticks out in these kinds of presentations. I'm not familiar with Sierra. The only thing I know about Sierra is that it must be a wonderful company because they are funding themselves at 225 times revenue. Investors are paying $225 for every dollar of revenue generated by Sierra in its most recent funding round. And so, private markets are maybe feeling flush with cash and they're excited about AI prospects, but certainly these valuations look very, very generous, shall we say. But do we see that in publicly listed mega cap tech? Again, I'll compare and contrast what we see today versus what we saw in March of 2000, right? March 2000, the 7 largest stocks in the market traded at an average price to earnings valuation of 60 times earnings. Indeed, we see Oracle trading for north of 100 times earnings. We see Cisco trading at 125 times earnings, right? I will say that it did not end well. We all know that. I think Cisco, 25 years later, I'm not sure if in the last week or so, it was getting close and I forgot to check back at it, that Cisco might have just got back to its share price, Karim, that it achieved in March of 2000, over 25 years later. What do we see in terms of valuations for the largest stocks in the here and now? Well, they're trading at 30 times earnings. That's not a cheap valuation, but we would and we can make the argument that that's a reasonable valuation in the context of these companies' prospects, right? And that's what brings us to the next slide here. S&P 500, as I mentioned, is trading at roughly 23 times earnings. These 7 largest tech companies are trading at 30 times earnings. So they're trading at a notable premium. But look, they're generating revenue and earnings growth far in excess of the market at large. They have balance sheets that are much lower in terms of debt leverage. So they've got much cleaner, stronger fortress style balance sheets. And the returns on equity, the return on the equity capital employed in these businesses is 3 times the rate of the S&P 500. So yes, they're trading at a premium, but we would make an argument that it's not obscene and that valuation premium is deserved based on the fundamentals. Okay, bringing it home here and then happy to take some questions. So thinking long-term, this is something that we spent a lot of time with clients on in the early parts of 2025 because it was a scary time. Like that was a really painful correction. It has been a long year for clients that had to endure that. It has been a long year for advisors, and it's been a long year for me and my portfolio advisory group colleagues. And when the call came to us, and the calls came to us in the spring to kind of put this all into context, again, it was incumbent on us to help advisors message to their clients. And I think a big part of that messaging is, hey, we need to zoom out here, right? We don't own equities for what's going to happen in the next 6 months. We own equities for the next 5, 10, 20 years to meet our long-term financial goals, right? And so there's a couple of data points, a couple exhibits that we use to kind of hammer home what we thought were some important messages in that regard. And so what you're looking at here is 25 years of returns on the S&P 500, right? And the steely gray bars, that is the total return in any one of those years. And the dark gray squares is the maximum peak to trough decline that we experience in the midst of any one of those years. And we can go back and look at almost 100 years of returns on the S&P 500 index and see that 60% of years, so 6 out of every 10 years, investors were forced to suffer a correction of 10% or greater, right? So the point I would make there is that corrections, as equity investors, suffering corrections is very much the rule. They are not the exception, and indeed, a 10% drawdown occurs in 60% of the years going back 100 years. Now, that being said, even years where we suffer a correction, and actually the median correction over all those years is somewhere in the 13 to 14% range, even in those years where we suffer a painful double-digit correction, we can still have a very good return at the end of the year, right? And that's what this chart was trying to portray, right? Think about where we were. I always cast a glance at 2020, another scary time for us all, for equity investors. The peak to trough decline in the S&P 500 in 2020, 34%. It's worth reminding ourselves that by the end of 2020, the S&P 500 was up 18%. You know, this year, another case in point, peak to trough decline on the S&P 500, 20%. Right now, we're up about 18%. So corrections are going to happen. They're the rule, not the exception. But even when we suffer years that we're forced to suffer through those corrections, we can still have a handsome return at the end of those years. And then last but not least, on the long-term mentality, I'll really focus on the left-hand side. The Canadian story is similar. It's just a little bit less dramatic. If you invested $100 into the S&P 500 on January 1st, 1980, and you held and you were fully invested for the last 45 years, your compounded annual growth rate would have been 12.4%, which is just phenomenal, right? You would have turned $100 into $17,000 45 years later, which are just eye-popping numbers. Now consider what would happen if you missed some of the best days in the equity market. If you missed the 10 best days, your compounded annual growth rate moves from 12.4% to 10.3%. So let's call it you lost about 2 percentage points off your annual return. Doesn't sound like a lot, but the impact compounded over 45 years is absolutely massive. If you miss the 25 best days, you're losing another 2 percentage points of returns. And again, compounded over 25 years, the impact on your wealth accumulation is severe. Now, I was presenting this chart once, and somebody, in the audience called out to me and they said, yeah, but you're not showing the impact of missing the positive impact of missing the worst days. And it was such a great question in so much as I enjoy countering it, because my counter argument is that it is impossible to consistently miss the worst days in the equity market as an investor, and to do that sustainably and consistently through your life as an investor. Because think of what needs to happen, right? You need to foresee that a correction in the equity market is coming, right? And you will certainly fear more corrections than what actually transpires, because there's always something to worry about in the equity market. So you need to correctly foresee that a correction is coming. You need to sell and get out at the top. And then last but not least, probably the most difficult, is you need to buy back at the bottom, right? And at the bottom, I promise you, it's not going to feel good to buy equities that day. There's not going to be a lot of good news. Maybe your neighbor just lost their job. There's going to be no good news for you in the financial press to suggest that that's a good time to be buying equities, but that's exactly what you need to do. So foresee the correction, sell at the top, buy back at the bottom. That's to miss the worst days but one time. But to do those three things and get them all right consistently through your life as an investor, I just don't think is going to happen. And so if you're going to be in equity markets, I don't think you can do that. The only way that you can miss the worst days is to not be invested in equity markets, period. But that's not a great way to meet your long-term financial goals. It is possible to miss the best days. That's what happens when you're maybe carrying more risk than you're comfortable with, heading into a drawdown like we saw earlier this year, and you call your advisor, and against their best guidance, you convince them to sell equity at the bottom, right? And that's how you miss the best days, because often the best days are clustered at those times of heightened volatility, and they come on the heels of some of the worst days. And we saw this in spades in April, following the Liberation Day theatrics in the Rose Garden. We had one of the worst 3-day slides that we've seen in financial market history. The only kind of comparable periods are like 1987, the tech wreck, the financial crisis, right? Very painful times. What happened just a few days later is first, Trump got on Truth Social and said it was a great time to buy equities. We're all wondering, what's this guy talking about? Well, later that afternoon, he told us what he was talking about, and he announced a 90-day pause on the Liberation Day tariffs, and equity markets went crazy. The S&P 500 was up over 9%. The intraday reversal would have been double digits. And if you got scared out of the market, you missed one of those best days. But it was just it was in spades an example of what I'm talking about. So, Karim, I've gone on for far too long. Let me just quickly reiterate some of the highlights here. We see growth economically in 2026. Tariffs are not a good news story, but the bite has been less severe than anticipated, and hopefully there's better things to come as we get into 2026. Markets have rallied to reflect the fact that recession fears have abated. That's the good news when we look at our statements. Not the bad news, but the flip side of the coin is that stocks are more expensive now, right? And so now they need to deliver against the earnings expectations that are in front of them. We're keeping an eye on inflation, keeping an eye on the labor market, we're keeping an eye on the AI narrative and making sure that we're not getting overly exposed to that narrative. And I think Canada is a good place to do that. Stay on target. You know, you're working with Karim. You've set intelligent targets that reflect your circumstances, your time horizon, your risk tolerance. You know, make sure that you're within shooting distance of those targets. And last but not least, hopefully I've encouraged you that when we see tougher days again in the future, which we no doubt will as equity investors, let's bring that long-term perspective back to the fore. Karim, I'll end it there. Thank you very much. Happy to take some questions.
All right. Okay. Well, thank you, Patrick, for a wonderful presentation. You just demonstrated why you're my a key go-to guy in the last 15 years for any questions I've had in the markets or the economy. So thank you for a wonderful presentation. I've got a whole bunch of questions here, but the interest of time, I'm going to sort of group some of the questions together. First, I want to thank everyone for sticking around and staying with us. We're going to take another 5-7 minutes for a whole bunch of questions I've got for Patrick. But before I pose a question, I just wanted to make one comment about gold. Patrick, you made some wonderful comments about gold. Gold has been, for a few, it was about a week ago, so I was talking to Martin at the Veritas Group, covers that space and everything. I'm looking at some of the research you've done, and I was, quite surprised, and for the audience to learn. And I'm looking at his research. that over the last, whatever, 45 years data that you had looked at, Patrick, was since 1980, if someone had been patient buying gold, and we compared gold to equities to real estate, I was shocked to learn that if somebody had been patient, gold actually has outperformed over that 45-year period. However, it required a lot of patience because there was huge periods of 15 odd years that you not only made zero in gold, but you lost money.
Yes.
Versus you did not in real estate and equities, right? So you required a lot of patience, just like bullion this year is shot through the roof. So you got to, it's a great hedge, but it's as Patrick, you and I call it, gold. Metals are meant to be rented, not to be owned, right? So it's you got to take, you got to be very, very, tactical on that space. So Patrick, I'm going to group some of the questions that have come in, and if you don't mind, if you can answer, we'll give another three to 5 minutes. The question came, if you can comment on the dollar currency, B, interest rates. Fed is probably going to ease. In the next meeting, if you want to take a bet on who the next Fed governor is going to be, I think you and I probably have inside track on that. So probably not fair. So that international markets and housing market as well. And last but not least, if you want to take a crack at it, is a crypto market.
Oh, right.
Cryptocurrency, bullion is, Bitcoin has shot through the roof and come crashing down, in a very brief period of time. So I'm going to group all of that. I leave it to you to tackle any way which you want. I give you creative freedom.
All right. This is like the lightning
to
round.
tackle whichever one you want
all the
first.
Questions at me at once. So it'll be a test of my memory if I can remember.
It's
those,
okay. I will toss others back at you if you forget. So go ahead, Patrick.
All right. Let's do it. So Canadian dollar, we're at 71, 72 cents today. The U.S. dollar has been weaker in 2025 against a trade-weighted basket of currencies. Nevertheless, the U.S. dollar relative to a lot of currencies still looks overvalued on a purchasing power parity basis, right? This notion that adjusted for foreign exchange, a Big Mac in Toronto should cost the same as a Big Mac in Tokyo, in New York, in Paris, right? And so the US dollar would still look on that basis to be a little bit overvalued relative to the Canadian dollar. That doesn't mean a whole heck of a lot because it can stay overvalued or indeed undervalued. Currencies can for protracted periods of time. You need a catalyst to kind of change that dynamic. And so we had a catalyst, I think, this year in the form of trade uncertainty, tariffs, diminished faith in maybe the independence of key U.S. institutions. We'll talk about the Fed in a second. And I think that knocked the luster off of U.S. dollar assets and the U.S. dollar in particular. Can that narrative continue to have legs into 2026? I think it maybe can. And then what's the catalyst for, Canada? I think if we can clear the air and understand that the USMCA will remain in place, if we can start to see progress on, and this is not all going to happen in 2026, but can we see this on the horizon, that we can get major projects built in this country, that we can start to see some of the private capital that the new budget seeks to attract to invest alongside public funds. If we can start to see that adding up to stronger Canadian economic growth moving forward in a country that is not overly exposed to the AI data center build out, which has been a huge, I think the numbers are, it accounted for over half of GDP growth in the US in the first half of 2025. So long story short, Canadian dollar at 71, 72 cents. Is the overvaluation there for the US? Yes. Are the potential catalysts there to be favorable to the loonie? I would say yes. And so I think there's the potential that the Canadian dollar can perform a little bit better into 2026. Rates. You asked about rates. So the Canadian Central Bank has had a couple cuts. We're probably near the finish line there because our policy rate was some ways below the US policy rate and already in kind of stimulative territory. The U.S. was cutting from what was probably somewhere in the neutral-ish range on their policy rate, and they're trying to cut ostensibly into a more stimulative environment. And so we expect that the U.S. Federal Reserve will cut again in December. That's certainly the market expectation at this point. And then I think the expectation is for, I think, another 3 cuts in 2026, whereas again, the Bank of Canada is probably closer to its finish line. What does that mean for, I mean, that's obvious what it means for the short end of the interest rate curve. What does it mean for longer term interest rates? It gets a little bit out of my kind of subject matter expertise in Canadian equities. You'd always get a better answer from my fixed income colleagues. But I think one of the risks that we're watching for, especially harkening back to that perception that maybe the independence of the Fed is at risk. Who's going to be the next Fed chair? It sounds like it's going to be Kevin Hassett, chair of the Economic Council. And I think the expectation is that he will be a bit of a Trump operative. And if Trump wants lower rates, then that's probably where he's going to try to steer the committee. And he's one voting member of that committee. He's not the whole committee, but it makes it incrementally easier for perhaps the White House to have some influence over the Fed and its deliberations. And if all else being equal, that pushes the Fed to be a little bit more dovish than otherwise the data would tell them to be. Dovish meaning more inclination to cut rates. Then what you could see is that long-term interest rates start to appreciate because all of a sudden the long-term end of the curve is starting to think about higher inflation
right?
Once again, right? So hopefully that answers interest rates, Fed. Let's see, we talked a little bit on crypto there. I don't have a crypto crystal ball. I don't know that anybody does. I think the volatility that you see from crypto is really suggestive of how much capital you should really think about putting in this asset, if at all. If you determine that, this is going to be digital gold and it's going to be a long-term, store of value, there's a very limited, finite supply of crypto, Bitcoin in particular, to be accumulated. You know what? I'm here for that argument. It makes as much sense for Bitcoin as it does for gold. I'm here for that argument. I'm here for the argument that crypto and Bitcoin has a appeal to people that live in countries under regimes where transferring their wealth is hard to do. I also understand that this is a very attractive outlet for money launderers, right? So it's not all good news story when it comes to crypto. But when I look at it, very volatile. I understand parts of the narrative, but to me, it looks like a very sentiment-driven asset with no real intrinsic value, and one that more often than not in recent years has been kind of a risk-on asset, where we traditionally think of gold as kind of like a risk-off kind of hedge, right? So that's kind of my comment on crypto. I missed at least 3 questions along the way, Karim.
So I've got so I'll make one quick comment on crypto, then we'll go to the last question. I'd like to give you 15 seconds in the interest of time. We've gone a little bit over time in the interest of time. I asked myself the question, what happened to the crypto space or after Trump is gone? Because with President Trump coming in, there's a huge he totally changed the narrative on that space with, everything that his family has been involved in, and that's been a tailwind to that. Whether that's a long-term tailwind or not, who knows, right? So I totally agree with you. If anybody's going to sort of, it's a gambling. If anybody wants to gamble on it, just put a very, very small.
I'm smiling because I don't want to comment on any family's self-interest, because I want to be able to cross the border and back to the U.S. for business purposes.
I hear you. I don't plan to go anytime soon, so that's okay. I'm safe for now. The last, if I can ask you to take 15 seconds to comment on, because I got quite a few questions on that. Your comment on housing.
Yeah.
Canadian market. We obviously going through, I guess, the first housing market correction in close to 40 years, right? Yeah. Early 90s is last time we had seen anything like this. If you can take 10, 15 seconds to comment on that, any thoughts you may have on that space.
Yeah, a couple quick comments. affordability is better because prices have come down. Affordability is still terrible, right? It's still a real stretch for many Canadians to think about getting into the housing market. It's economics 101 in terms of why we've seen some economic or some housing market weakness, right? We went from an era in the wake of the pandemic, almost just exactly 5 years ago. Money was free, money was costless, right? Now money has a cost, right? I renewed my mortgage at a 4 handle this year. It was a 1 handle the last time I had a mortgage 5 years ago. And so now that money has a cost, your purchasing power is crimped, and that's going to have an impact on demand. I think the other aspect that's having an impact on demand is for a long time, we had incredible population growth that was kind of just unsustainable for the social infrastructure to support it, whether it was housing, the healthcare services that we're able to provide. And so we've right-sized this, but we had too much, and now we've gone boom, and now we're at 0% population growth. So we've turned it off in a real hurry. But with that population growth having arrested, that's another kind of tailwind that's being removed from the demand side of the equation. So it's not too surprising with those two hits: money having a cost, population growth being arrested, as to why we're seeing some housing market weakness. Maybe we're seeing some tentative signs that might stabilize into 2026. I think from our perspective as Canadian equity money managers with my colleagues here, I think what has been the good news story as it pertains to the housing market is that the mortgage shock, the mortgage payment shock that we were fearing has been less severe and less impactful on the economy at large than we had feared, as interest rates have receded off their peaks. And so that's been kind of the good news story on that front.
Yeah. Well, Patrick, thank you again. Thank you for your time today. Thank you for preparing for this presentation. Really, really appreciate it. Thank you for all of you who attended this webinar. Apologies for going a little bit over, but I appreciate you staying to the very end. There's quite a few questions that I did not get to due to time. I will present this one or two to Patrick and respond back to you. Hopefully, we've covered on everything in the one group question that I asked Patrick. Thank you again to everyone who attended. If there's any questions anyone has got, please feel free to call me at 416-956-8888. Again, 416-956-8888, or feel free to email me at karim.visram@rbc.com. Thank you again, Patrick, and thank you for everyone for attending. Please have a wonderful rest of the day. And if we don't speak, a very, very Merry Christmas to everyone, to you and your family. Patrick, have a safe vacation, safe journey with your family on Saturday, and look forward to talking to you when you come back and tell me all about your vacation.
Sounds great. Thank you very much. Thanks for having me, and thanks to everyone who did stick around.
Okay, thanks everyone.
Thanks, everyone.
Bye-bye. Bye-bye.